The UK is officially cracking down on crypto, and it starts tomorrow, November the 10th. The Bank of England and Treasury are about to publish the most important crypto consultation in British history, setting strict new rules for stablecoins, digital payments, and every exchange or business that touches crypto. We're talking about potential £20,000 holdings cap per person and £10 million limit per business, and a brand new joint oversight model between the FCA and the Bank of England. So what exactly happens on November the 10th, and why does it matter? Let's break it down clearly, calmly, and without any hype, because this is the day the UK's crypto future changes forever. Welcome back to my channel. My name is Milkshake Matty. I'm the founder of Crypto Wolfpack. Today's video is a huge one for everybody trading or investing here in the UK. The government has been talking about crypto regulation for years, but now it's finally happening. Before we dive in, if you want to see the exact strategies I use to make money in crypto, even in the bear markets, check out my free Crypto Liftoff course. There's a link in the description. Right, let's talk about the UK's biggest crypto rule change ever. Here is exactly what's happening. On November the 10th, 2025, the Bank of England and the Treasury are releasing a new stablecoin consultation paper. The final stage before the UK brings in crypto assets formally inside financial regulations. As part of the Financial Services and Marketing Act of 2023, which gave regulators power to supervise crypto the same way they oversee banks and payment systems. It's part of the Financial Services and Marketing Act 2023, which gave regulators power to supervise crypto the same way they oversee banks and payment systems. The consultation sets out the full framework. The FCA will license and monitor stablecoin issuers, and the Bank of England will step in when coins become systemically important, meaning it's widely used for payments and settlement. The key rules being proposed include these: one-to-one reserve backing in cash or short-term government securities, guaranteed redemption at face value within 1 working day, independent audits of custody reserves, and licensing for payment providers that move or store stablecoins. In short, if you're using or issuing a stablecoin in the UK, you'll soon have to play by the same rules as the banks. So why is this happening now? Because the UK has been promising to become a global crypto hub, but it's been losing the ground in the rest of the world. The US has a Stablecoin Clarity Act. The EU has already launched MiCA, which regulates crypto across 27 countries. The UK had to act fast before being left behind. Regulators also learned from disasters like Terra, Luna, UST, where billions vanished because reserves weren't real. The Bank of England wants to avoid that at all costs. Stablecoins used for payments will now be treated like electronic money, transparent, audited, and redeemable. This is the start of a crypto growing up in Britain. Now, this is the part that's causing the most amount of noise. The Bank of England is proposing limits on how much stablecoins you can hold. Individuals may be capped at a maximum of £20,000, and businesses may be capped at a top of £10 million. Their logic is that in crisis, if everybody tried to redeem at once, it could threaten financial stability. They want guardrails to stop the digital bank run, but many in crypto see it as control, including me. I think it's a way to restrict freedom and track spending. And let's be honest, both arguments have truth in them. On the one side, we've got stability and protection, and on the other side, we've got control and limits. Either way, it shows the UK wants a regulated digital money system, not a Wild West one. Here is how the system will actually work. Any company issuing a stablecoin to the UK customers must apply for an FCA authorization. They'll have to provide full one-to-one backing, store reserves in ring-fenced accounts, provide daily liquidity reports, publish independent audits. Payment providers using stablecoins, exchanges, wallet apps, DeFi bridges must also register. The FCA will supervise day-to-day conduct while the Bank of England takes over if a coin becomes widely used for payments. So small issuers will go to the FCA, and the big systemic issuers, they've got to go to the Bank of England. It's the same split you see between fintechs and banks, just applied to crypto. So let's talk about what this means for you and me. Number one is safety improvements. You'll finally know whether your stablecoin is genuinely backed. Number two, the choice may shrink. Some overseas issuers might have to leave the UK market to avoid licensing costs. Number three is tax clarity. Stablecoins could be recognised like e-money, and that'll be simplifying accounts and audits. So short term, some disruption. Long term, hopefully, more trust, cleaner markets, and more institutional money entering crypto. So let's put some of this into context. In the US, Congress is finalising the Clarity for Stablecoins Act, letting state chartered banks issue their own coins. In the EU, the MiCA framework already focuses issuers to publish reserve breakdowns and hold capital buffers. Now in the UK, we're joining that race. Together, these three regions are creating a global template. Stablecoins treated like digital cash, fully backed and regulated. The difference in the infrastructure is this. In the US, state banks plus federal oversight. In the EU, it's centralised ESMA model. And in the UK, we've got dual regulators, the Bank of England and the FCA. For traders, this means we might have some crossover. The same coin could one day be valid across all three regions. But reactions are split. Crypto UK, which represents most major exchanges, welcomed the clarity. They say regulation will weed out the scams and make UK safer for investors. But DeFi developers warn that strict rules will push innovation offshore to Dubai, Singapore, or even El Salvador. Businesses are also raising eyebrows at the £10 million market cap. Large corporations that use stablecoins for treasury management say it's far, far too low. And privacy advocates worry about data sharing because under the new model, issuers must provide holder information if requested by authorities. The debate basically boils down to this: safety versus freedom. Here's the bigger picture. The Bank of England is already testing the digital pound, its central bank digital currency. Stablecoin regulation is the bridge towards that system. Once the digital pound exists, you could have public money or CBDCs and private money, which is regulated stablecoins, coexisting together. But it also raises questions in my mind. If the CBDC can be programmed, monitored and limited, do we really want caps creeping into private crypto as well? Or will competition between stablecoins and CBDCs keep both honest? I have my worries. Time will tell, but make no mistake, these rules are laying out the foundations for a programmable money era in the UK. So what happens next? You can expect some volatility. That is one thing for sure. Great British pound pegged coins and UK listed exchanges could see price and volume swing as traders reposition. If investors see this as a positive regulation, confidence will rise, institutions will enter and liquidity will grow. If it's seen as a crackdown, we might see capital flight to offshore platforms. Either way, November the 10th sets the tone for how Britain fits into the global crypto economy heading into 2026. Here's what I think your action plan should be as we head into the new regime. First of all, you need to stay liquid. Avoid locking up too much any UK issued stablecoins until licenses are confirmed. Number two, secure your assets. Use a cold store wallet like a Tangem. There's a link in the description with my discount code. And number three, keep records. Tax and compliance reporting are tightening. You need to track everything. And number four is don't panic. Regulation doesn't mean crypto is ending. It means it's maturing. Governments don't regulate things they plan to ban. They regulate what's here to stay. So here's my honest take. The UK is doing the right thing by bringing crypto into the light, but it has to strike a balance. £20,000 might sound fine today, but the limits can always be tightened later. Still, the framework legitimizes the space. It gives investors clarity, keeps issuers accountable, and pushes crypto closer to the mainstream adoption. I'll always prefer freedom over control. It's just how I'm built. But smart regulation done properly could make the UK one of the safest, most credible crypto markets in the world. Now it's your turn. What do you think? Is this genuine progress, or is this just more government control and outreach disguised as protection? Drop your thoughts in the comments, and I promise you I will read all of them and try to respond to as many as I can. And if you want to learn how to trade confidently during the regulation shifts exactly like this, then check out my free Crypto Liftoff course. There's a link in the description, and it's the exact system I use to profit during the bear markets as well. Thanks for watching. My name is Milkshake Matty. Please hit that subscribe button, smash that like button, and drop me a comment down below. Tomorrow, November 10th, marks the start of the UK crypto crackdown. We'll be watching it together, breaking it down live, and helping you stay ahead of the curve. I'll see you in the next one. Stay sharp, stay focused, and as always, the strength of the wolf is in the pack. I am not a financial advisor. This video is based solely on my opinion on what I am personally doing in this market. I also want to let you know that some of the links below and in the descriptions are affiliate links, meaning I may get a commission, but it will be at no extra cost to you. Please remember that under no circumstances will I ever contact you and ask you for investments. You can confirm all of my real social media handles in the description and also at milkshakematty.com. This content is for educational and entertainment only, and I am not a financial advisor.